Hey guys, welcome to my channel. We have a special guest with us today. This is Adam. We actually met online on Facebook. I was browsing on Facebook groups looking for like-minded military members that were interested in investing, and I came across this Facebook group called Like-Minded Military Investments, and I joined it, and I started posting questions in there asking like, hey, what is this that I can learn about stocks? How can I benefit my portfolio better? And Adam came across and he spit some massive value. I mean, that's how we first met. And to throw things off, Adam, if you just want to introduce yourself, tell us, your military history and how you got into stocks and everything. We can get started from there.
Sure. Thanks, John. So I joined the military in 2010. I graduated from Pensacola Christian College in May of 2009 and kind of just stayed home for a year, enlisted in the Air Force, went to basic in April 2010. And so I've been in for about 10 years now, a little bit over that. I started interested in investing in the stock market when I was stationed in Colorado Springs. I was there for almost 8 years. And I believe in 2015, I was just listening to this radio program. I just drove to work one day and they said, hey, we're coming to town and we're going to teach people about investing in the stock market. So if you're interested, go to the website, register, sign up. And so I did. Now the company's called Tradeway, and they're still active. They're doing online seminars now with the current events of the world. So they're not in person like they used to, but you can still register for the online events. But that was my first introduction to the stock market. Was it going to a 2-day seminar by Tradeway, and they taught me the basics of trading. And it's been a journey ever since. I'm not a pro, I'm not an expert. There's so much I still have left to learn. But what I have learned, I wanted to share with other people. And so I was in Colorado Springs for about 8 years, from 2010 to 2018. And then I was stationed in Osan, South Korea for a year. And now I'm at Andersen Air Force Base, Guam. I've been here for just over a year right now. And as I have the opportunity, I like to teach people and give them the knowledge that I've gained and share with them the mistakes as well as the benefits that I've received from this.
Awesome. Hey, thank you for sharing your background with us. And for those of you who didn't catch on by now, today, this episode is going to be about stocks, how to invest in the stock market, some basic tips on how you can best get a good portfolio rolling at a young age, or even whatever age you're at or wherever you're at in your military career. It's never too late to start. It's better late than never. So I think today is a great day for you guys to take advantage of this opportunity we have together. And Adam's going to definitely run us through some great scenarios and great investment strategies that you guys can utilize today in actionable steps. So very simple stuff, nothing too advanced. I myself do not consider myself a professional investor or a professional stock, analytic person at all. But I think by bringing other people who are knowledgeable on the subject will really help expand what the stock market is and how you can take advantage of it, because it's a very important market that I think it's not very, what's the word I'm looking for? It's not really used at its full potential by a lot of people. And I think a lot of people are missing out on that. And with that starting out, Adam, you said you first got started with stocks and investing because you were listening to a radio talk show back in Pensacola, Florida. Is that correct?
It was I graduated college at Pensacola. I was listening to the radio in Colorado Springs in my first duty station. And just driving, it was something that I think we're all interested in making money. Mm-hmm. I think we all, of course, have that desire. And some of us have a bit more of a drive with the entrepreneurial spirits, as you yourself is obvious with all of your endeavors and all of your focus. And that was mine as well. Like, how can I take advantage and how can I leverage my resources better? And a lot of times all we hear is, oh, just invest in this mutual fund or just invest, contact an investment advisor and they'll tell you where to put your money. And that's the basic strategy of what I was doing. Was I contacted my bank and they said, oh, we'll set you up with a financial advisor and give me the interview of what's your risk analysis and your objectives and your growth potential and what's your budget and all the things that a financial advisor will ask you, all great questions. But what I learned from Tradeway is that ultimately what you do with your money is still up to you. And so you can have direct control over it, or you can give it to somebody else and hope they know what they're doing with it. And I think the more you learn, the more you study, the more you read, the more you listen to different podcasts or different videos on the subject of investing or trading, you're going to pick up different objectives, different lessons that work for you that might not work for others. And the thing with investing is that it's such a broad topic that there are so many different strategies and ways to go about it that I can do it differently than you do it, but it can still work out. And I think the key thing I want to teach people is find what works for you. We can lay the groundwork, we can lay the foundation, but I want you to build on it so that you can take control of your own personal finances and then in turn teach the next generation. Teach other people. This isn't information that's meant to be held close and hogged. It's meant to be shared, I think. And so that's why my intentions are is to share this knowledge with as many people as are willing to listen.
I like what you said there, Adam, to take control of your money and make it work for you. So you talked about starting off in the stock market. What age did you start out, and what were you just beginning in the military? Were you, right out of boot camp?
No, I was actually been in for about 5 years. So I was close to 30 years old by the time I actually started. Okay. And I know that there's a lot of debate on you need to invest early, yes, but I think it's key to get your feet under you, get a good financial foundation built before venturing into the risks that come with the stock market, as also the rewards that come with the stock market.
Oh yeah.
But there is a way to go about it. It's not just blindfold yourself and throw darts. There is a strategy involved. There is a plan. There's an objective that you can sit down and you can plan for yourself. But yeah, I was about 30 years old before I started to seriously learn about how to properly invest or how to get the basics of that. And it's just the past 5 years that I've continually learned something new, it seems, almost every year, sharpen and polish what I do know and add something else to it. And that's what I try to pass on to others so that they don't make the same mistakes I do, and hopefully teach them early enough, then all of our life experiences get passed down to them, and so they can gain our experiences at a younger age, and it'll benefit them greater than it has been to us.
I like what you said there, to pass on the same information that you learned and to prevent others from making the same mistake as you. I think the one thing I wish I had learned earlier joining the military as young A1C back at 18 years old, I wish I had that mentor, someone like you that taught me the ropes on, hey, stop fucking blowing your money. So, stop blowing your money out, drinking, partying. Right. Instead, put money away, put it into a Roth IRA, put it into an individual account, and start building that portfolio. Because 10 years down the road, it'll definitely snowball. And if you just keep putting money into it, it's going to keep growing for sure. And I think a lot of people that are joining the military need this information. I feel like they need to teach us at the AFRC or the Right Starter. What you put in process your basis needs to become a part of, for one, our education system. I think it's not taught enough in the system. And to get
in the Air Force, the Airmen and Family Readiness Center does offer free financial counseling and advice to airmen. And I think unfortunately, there's just not very many people that take advantage of that. But the military does provide that resource. It's just not utilized. There's a lot of resources the military offers that people just don't take advantage of. And so the resource of a basic financial, they can sit down and form a basic budget with you, basic financial plan, and give you basic investment objectives. But again, I think it's important that we take that knowledge and expand on it and learn even more than what they're able to teach us.
Most definitely. I'm actually going to be interviewing one of my buddies who works at the AFRC as a financial advisor. He's helped me out with my stocks, and also with this whole tax deferral stuff coming up too. That's a later topic down the road. For those of you who are watching, if you guys are interested in learning about, hey, how can I take advantage of or prevent a crazy headache down the road, make sure you comment down below if you're interested in getting a video like that made, because we are looking at making a video about that in the future. But for our beginners out there, Adam, if you could explain what exactly is the stock market. I mean, and I know the name in itself should be pretty self-explanatory, but I know there's kind of some people out there, including myself at the start, that didn't really truly understand what the stock market is and how you can make money investing in the stock market.
Oh, absolutely. So you start with what a stock is. I think when we hear the word market, most of all of us will know what a market is. But what is a stock? A stock is owning a share of a company. So you can be part owner of a company like Walmart or Facebook or Tesla or Apple or whatever company you happen to like, whatever brand you happen to enjoy. You can have the possibility to be part owner of that company and share in their profits as well as their losses sometimes, unfortunately. But that's part of being a company, right? You take the risk with the rewards. You can't have one without the other. And so what I like to tell people is think of it like a grocery store. If you walk into an American grocery store, you might only want a loaf of bread. But to get to the loaf of bread, you got to get to the aisle that's usually in the bakery section of the grocery store. But you're going to pass the produce, and you're going to pass the dry goods, and you're going to pass the deli, and you're going to pass the dairy, and all those other places around there. And that's similar to what the stock market is you might only be interested in a certain company, but you got to walk past hundreds of thousands of other companies that are all trying to flash the lights and grab your attention because they want you to buy part of them. And so you need to zero in on what are you here to get? You just want that one loaf of bread. And so you finally find the bread aisle. Okay, well now, what particular bread did you want? Did you want wheat bread or white bread or raisin bread or cinnamon bread? Did you want pumpernickel? Did you want pie? And so we're overwhelmed in America. We've been blessed with all of these choices. The stock market is the same way. So when you hear a stock, it's just a piece of a company. If a company wants to raise money, that what they do is they can file an initial public offering, an IPO. And what that does is it takes their companies called going public. And now you're able to buy shares of that company, being part owner of that company. And so you pay that company, and in turn, they give you part ownership. That's how they raise money. Perhaps they have a new product they want to market, they want to do some research. All different reasons that a company could want to raise money. And going public on the stock market is just one way they do that. And so the stock market is a market full of all those hundreds of thousands of different companies that have a public stock offering available for you to buy.
I see, okay. And you mentioned earlier that, yes, you should have a good foundation before you get into the stock market. And I've heard a lot that it's good to start when you're young, but why do you bring up the point where you should have a good foundation? Obviously, there's a risk involved when you're investing.
There is.
Are there some strategies to starting earlier versus, starting later with a more financial foundation? And how can people best prepare themselves to not, make that mistake of throwing all their money in on, for example, Tesla or whatever, and see how it drops the next day? What is some advice you can give to new beginners on getting into stocks and, buying a stock or selling a stock? What would you say to them?
With going back to the foundations, I compare it to with your finances, you're going to build a house. And when it comes to building a house, you have your foundation, and then your framing, and then your finishing. So with your foundation, that's pouring the concrete. Everything is going to rest on that foundation. And the strong foundation is going to determine if a windstorm will blow that house over or if the house will stay up and be able to withstand the elements and the weather. And so what I like to encourage people is to form a budget. And a basic budget is going to be your foundation. How much do you spend each month? How much do you make each month? Where can you allocate different funds? And so from that, then you put the framing up of the house. This is where you look and you'll see the walls being built. That's when you can start to put money into savings and put money into investments. And then when it comes time to choosing an investment, there's a process. I don't want to scare people with these big words, but you have to analyze. And a lot of people think, I got to analyze the stock and I got to analyze the market. And that's just too much experience that I don't have, or I don't know how to do that. But it's actually a very simple process. I've made a PowerPoint that I've used and I send to different people. So anyone who's interested in that, you have a copy of it, or they can contact me. They can go on if they're military, the Facebook page of Like-Minded Military Investments. I have a copy on there. It's free. It's not it's not the most professional they'll ever see, but it's just general information. I want to prepare a step-by-step process of how they can find a stock that's right for them. And it's just the different ways to analyze a stock, analyze a company. And the thing to keep in mind is when you buy a stock, you're buying a company. And so don't just go out and buy a stock because it's the popular stock you've heard about or all your friends are buying it. If you're going to buy a stock, you need to research the company that stock belongs to. So if you're interested in buying shares of Apple, you can't just go out and buy Apple. You can, but I encourage you not to without first examining Apple as a company. Get familiar, and that might be an easy example because there's many people out there are going to say, well, who hasn't heard of Apple? Who doesn't know what Apple does? I'm just using that as a basic example of let's use that as our foundation of investment knowledge. If you're familiar with Apple, okay, what does Apple do? What products do they make? What products do they sell? What services do they offer? And if you're familiar with that, then you start digging into, okay, what's their foundation? Are they a solid company? Are they making money? Or are they a company that's almost going to be bankrupt? Then look at their stocks. You can find a stock chart, and it's publicly available. All this information is available. I use Yahoo Finance for a lot of general research, and you can find information on the financials of the company. Have they been making money for the past few years? I'll look at what the volume of their shares are. How many people are buying their stock? Is it a lot of people going in to buy this stock, or is it just a few people? How popular is it? You can find the health of their stock. Is their stock going up? Is it going down? Stocks make trends. Stocks make patterns. And a lot of people think the stock market is just gambling. And it is if all you do, like the earlier example, is blindfold yourself and throw darts, hoping I hit something. Oh, I'm going to put money in here and hopefully it grows. I'll buy this company and I think this is good. There's risk involved, but you can learn to lower that risk and still make sound investments by doing the proper research.
So research is a big part of obviously investing in the stock market. If you were to give a beginner 3 actionable steps onto buying their first stock, what would it be? So you mentioned you use Yahoo Finance to research your stocks.
Yes.
And when you're looking at Yahoo Finance, what exactly are you looking at? You mentioned volume, which shows how much people are buying the stock, and how does that indicator tell you, hey, this might be a good stock to purchase? Like, what are 3 steps you would take as a beginner?
So what you have is you start off with what is known as fundamental analysis. That's not a term I made up. If you even talk to professionals, they're going to use the multi-part analysis. And fundamental analysis is looking at the health of the company. The volume of shares is the number of shares that are being traded. It's not necessarily the amount of people that are buying it, it's the number of shares being traded. If you have 10 people that own 1 share each, or 1 person that owns 20 shares, the 1 person has more volume than the 10 people because he owns more shares than the other 10 do combined. What the volume shows is who is buying it. Because if you look at the price of the stock, a lot of these stocks are $10, $50, $100. And as you see that stock rising in price, if that volume is in the millions, or say 500,000 or higher is what I advise people. You can find that on Yahoo Finance. If you download my PowerPoint, I show you a step-by-step guide on how to do that. But look at that volume. If the volume is really low, that means there aren't that many people buying it. If the volume is really high, now all of a sudden, okay, what would be necessary to make that volume go that high? And the answer to that is it takes money. Let's say you take Apple, a $100 stock. Let's say Coca-Cola, a $50 stock. You know, there's stocks that are less than that, stocks that are more than that. But if you say, oh, the volume is 1 million, well, what's 1 million times $50? Or what's 3 million times $100? And the quick answer, for those of you who are mathematicians, some of you might have just been able to do that in your head and spotted the answer out very quickly. For a few of us, we might need to use a calculator, and it might take us a minute or 2 to figure that out. That me as well. But what that shows you is, okay, who is involved in this? And that shows you it's the professionals that are involved. These are the millionaires, the billionaires. These are the people that manage the mutual funds, the hedge funds, the retirement funds. These are the people that have the millions of dollars to go out and buy several 100,000 shares of a certain company. And that's what moves the volume up and down. I certainly don't have enough money to go out and buy 100,000 shares worth of a $50 stock. But if I'm giving my mutual fund manager $100, and you're giving them $100, and 100,000 other people are giving them $100, all of a sudden he now has the ability to go out and buy that many shares in a company. And the professionals do all the research that you and I might not have time to do, or you and I might not know how to do. They're looking at the bank statements of the company. They're looking at their books, their income statement, their balance sheet, their cash flow. They're looking at the prospectus. What does this company plan on doing for the next few years? What are the emerging markets? What are the current markets? That's what they get paid to do. And so we're just using their knowledge and saying, oh, if they're interested in buying it, they think it might be a decent buy. And so we can say, okay, that's check mark number one. Then I would go in there and do my, double check them slightly, and I'd go into what's called the financials tab on Yahoo Finance, check their income statements. And I want to be interested in what the net income is, because the net income tells me, has this company been making money for the past 3 or 4 or 5 years? And by using, that's just step one, fundamental analysis. By doing that step, you can say, okay, the company is healthy. And from there, that's your building block. And then you go on to check all the other boxes to see if it's an investment that might interest you.
I see. Okay. Wow. Thank you. That really helped clear things up, even for myself too, to know those actionable steps. Now you mentioned mutual funds, sort of, when you're giving the money to a expert that's knowledgeable in the field, and he's the one that's placing the buys and sells for you, managing your portfolio. Now, for me, when I started stocks, I was so confused on the difference between what is an ETF, what is an index fund, what is a mutual fund, what is a trust, what is an individual stock. Do you mind clarifying the differences between all?
Oh, yeah, absolutely. It can be confusing because there's a lot of terms that are very unique to the stock market, and it can be a foreign language sometimes. You'll read articles or hear news clips, or you're just looking at all the different terms and words used in the stock market and have absolutely no idea what they mean. So let's start with what is stock? It's a single company. A mutual fund then is a collection of different companies. And what I like to tell people is compare a mutual fund to a basketball team. So a stock is you playing one-on-one. And whether or not you win or lose that game is completely dependent on just your skills against your opponents. Whereas if all of a sudden now you bring a team into it, now you have more players on the court and more players on the bench. So with the stock, if that stock is doing very well, if the company's performing well, hey, the game is being won. But what happens if all of a sudden that company starts performing poorly? Your score starts dropping, your opponent starts outscoring you, your investment might not be doing as well. Enter a mutual fund. You have a coach or a mutual fund manager who's out there and he's coaching his players. He has 5 players on the court. I'm just using this to keep with the basketball analogy. You're more than likely to have more than 5. I like
that analogy. It's helpful. Puts the picture in my head.
So you're going to have more than 5 stocks usually in a mutual fund, but let's just keep it with basketball to try to keep it simple. You got 5 players in the court, and one of these players is just not performing that well. One of these companies, so each player counts as a company, it's a stock. And the other 4 are doing well, but this one player he's not making a shot, he's not passing the ball well, he's just dragging the team down. So what that coach is going to do is he's going to make a substitution. Okay, hey, call timeout. We're going to take this player from the bench. We're going to put him in the game and take the player that's not performing well and put him on the bench. Hopefully what that does is all of a sudden now the team starts moving together well. Maybe the point deficit starts decreasing. Maybe they come back from behind. Maybe they start winning the game. That's what a mutual fund does. And an exchange-traded fund, or an ETF, is similar to that. It's a collection of funds. To understand the key difference between an ETF and a mutual fund, you have to understand how a stock is traded. The United States stock market, the New York Stock Exchange, is open from 9:30 a.m. to 4 p.m. Monday through Friday, Eastern Time.
Okay.
Monday through Friday, and excluding some federal holidays. So let's say Christmas, December 25th, landed on a Wednesday. The stock market, the New York Stock Exchange, would be open on Monday, Tuesday, Thursday, Friday, and they'd have Wednesday off. A holiday. So barring some federal holidays, the New York Stock Exchange, the stock market in the United States, is open Monday through Friday, 9:30 a.m. to 4 p.m. A stock gets traded throughout the day. It has an open price, a low price, a high price, and a closed price, and that price fluctuates throughout the day. So an exchange-traded fund is similar to a mutual fund in that it's a collection of stocks, but it trades, its price fluctuates throughout the day. And throughout the day, you can buy and you can sell, you can trade it on and off. You can't do that very often. That's known as day trading. That's different than investing. That's a different strategy you'd have to learn. But a mutual fund only has one price. It's just the closing price. And that's taken at the end of the trading day. So you have different risks associated with those. Let's say you want to buy just a stock. With that single stock, you gain all the benefits. If that stock is on the rise and it's going, let's say it's hot, it's a hot commodity, then you gain all the benefits of that stock rapidly rising. But all of a sudden, if that company performs poorly, has a bad news report, the stock just starts going down, you have all the risks that go with it, and so you might lose your investment value quickly as well. A mutual fund typically doesn't rise or fall as quickly as an individual stock does because it has so many other stocks to balance that out. That doesn't mean mutual funds don't fall. Mutual funds will still fall, mutual funds will still rise. But a lot of times they do it slower, at a slower pace than an individual stock. An ETF as well. The difference is, let's say you're on the news and all of a sudden you're here on the news that the stock market is going up today, the stock market is rising, and you think, oh, I should get in on this before it gets too high. If you contact your investment advisor or you go to your broker and do it yourself and you buy into a mutual fund, it will not buy it until the end of the day. And by that time, the price could be higher than what it was when you heard the news.
Let's see. Okay.
And let's say you own a mutual fund and you hear, oh, the stock market's going down today, it's dropping, so I want to get out of it. And you go to the mutual fund and say, I want to sell it now before I lose too much money. It will accept your order, but it will not sell it until the end of the trading day.
I see. Wow.
At that time, the price will be lower. Now there's debate as to whether or not you want to actively manage a fund. Buying and selling actively is what I'm mentioning here. And if you don't know what you're doing, then don't do that. This is just a bit more of a step above basics. But that's the difference between a mutual fund and a regular stock. Is one, you gain 100% of the risks and rewards associated with it. You might rise and fall very quickly. The other one might be considered safer. And I use the air quotes in that because there's nothing safe in the stock market. Some people like to use the term, well, this is a safe investment. There's no such thing as a safe investment because investment has the potential to go down and to lose value. So there's no such thing as a safe investment. What there is each investment has a way to manage the risk associated with it. And so mutual funds are a way of managing risk because you're not putting all of your eggs in one basket. They're spread out, hoping that you can take advantage of different industries, different sectors, and that if one stock starts to drop rapidly, the other stocks will keep that buoyed and keep that fund from dropping as well, and possibly even keep it going up. While the single stock might drop, a mutual fund might go up because there's all the other stocks to balance it out.
Okay, I see. So is an ETF and an index fund the same thing, or are those two different as well? Because I've seen those terms used intermittently as well. I know.
So an index fund is a special type of fund. You can have a mutual fund or an exchange traded fund that are index funds, or they can be industry funds. And an index is something similar to what is known as the S&P 500. And you might hear these in reports that you hear or any articles that you read. You hear about the S&P 500 or the Dow Jones Industrial or the NASDAQ Composite. Those are indexes. And what they do is it's just a collection. So the S&P 500 stands for Standard & Poor's, which is a financial company. It's a financial company that's been around for 100 years or more. And they do a lot of research into all these different investments into all these companies. And Standard & Poor's has come up with a list of 500 of the largest companies in the US stock market. And so that's an index. They said, we've done the research, we've done all the math, we've investigated the company, we've investigated their stocks, and we think this is worthy of being in the top 500 all-stars. And so that's an index. The Dow Jones is the 30 largest companies and stocks in the US stock market. And the NASDAQ is more technology focused with a few other companies thrown in there. But those are all indexes. And so what an index fund does is it follows those major market indexes. So if you find a mutual fund or an ETF that is an S&P 500 index mutual fund or index ETF, that fund will follow the S&P 500 index. And we'll just stick with that. There's many different indexes out there that you can look up on your own sometime. But just sticking with the S&P 500 for now, did you know that the thrift savings plan, so for those of you in the military, those of you who are federal employee and have access to the TSP, the thrift savings plan has an index fund known as the C fund. And the C fund follows the S&P 500. And so if you're interested, if you're military or federal and you're interested in your TSP doing what the S&P 500 does, you can invest in the C fund. And that is an index fund that follows the market index. And so that's an index fund. You might have, maybe you'll have an industry fund. And an industry fund will follow a particular industry. Let's just use the automotive industry, for example. It would be a collection of companies such as Tesla, Toyota, GM, Ford, and all those companies be brought together into one fund that the fund manager would manage and operate. And so you do that mutual fund, and it would be a good overall example of what the automotive industry is doing. If the automotive industry as a whole is on the way up, then the industry fund might be going up as well. If the automotive industry is all going down as a whole, then the industry fund might go down. And that's an example of a comparison and contrast between an index fund and an industry fund. So that's the basic answer. Is an index fund just follows a major market index, such as the S&P 500, the Dow, or the NASDAQ. And if you don't know what you're doing, you're just getting started with investing, you don't know where to start, an S&P 500 index fund is a great place to start for beginners. Even for veterans, it's a very good basic fund that typically has a decent return. It's not going to give you the very best return in the market, but it'll still give you a better return than if you just stuck that money in this savings account.
Oh yeah, one of my buddies, that got me into the stock market, he showed me how much you're actually making with a savings account, sometimes even losing with a savings account compared to investing in stocks. And when he showed me that, I was like, what the heck? This whole time I've been in the military, I've been putting all my money into savings, and here, back at him like, wow, in a year I've only made $20, for hypothetical, like that's crazy. Whereas, for example, with say Tesla, if you had bought it, say in March when it was dropping, that's my biggest regret. When it was dropping like crazy, it was I think at $300 a share.
Right.
And then right after, I thought, that's gonna keep dropping with COVID and everything. Nope, went the complete opposite way. Hey, 2020 hurt us. They were like, hey, nope, it's gonna go the other way. So now it went up to, I think it was like 2.5K. That was the highest it went to. And then Tesla announced that they were going to be splitting their stocks. And that's second thing actually I wanted to ask you about too. That's a hot topic right now. With Apple and Tesla splitting their stocks, why did they do that? And two, how can people take advantage of this opportunity? And is this an opportunity to get into Apple and Tesla right now with such low price?
Great, yes. Splits are a particular, they don't happen very frequently. They happen more often with some companies than others. I think this was Apple's 5th split in its history. This was Tesla's 1st. So some companies that have a history might split themselves more often than others. What a split is remember, the stock is part of a company. And so what that company does is they might say, well, we want more money, but our stock is so high, the average investor might not be willing to buy it. The fund managers, the people with more money, can afford to buy, one share of Tesla at $2,500 or more shares at $2,000 per share. But for me, that's a little bit outside of my risk tolerances. I'm not sure when I'm pay $2,000 and get just one share of a company. And so those companies realize that. Those companies might realize, hey, our stock price is too high. Not every company does this. Some companies will never split. Some companies will just say, our stock price is rising. That's the value of our company. You can get on board.
Berkshire Hathaway is one of them. I was looking at their shares. It's like, how much is one of their shares? Like, it's in the thousands. I think like almost 10,000 for one share. I was like, what the heck? That is crazy.
Yep. And some companies haven't split. Some companies just decide, that's the value of our company. Either you're in or you're not. And that's, that's totally up to them. No fault in them. It's just, I can agree with that. Either you're with them or you're not. And then there's other companies that decide, you know what, we want more people to be able to afford to buy shares of our company, so we're going to split it. And what that does is, using the example of Apple and Tesla, I think Apple's price was up to 500 and Tesla's was close to 2,000. And when Apple did that split, all of a sudden their share price, they give you a 5-for-1 split. And so for every one share that you owned, now all of a sudden you had 5 more free. You didn't have to go out there and buy 5 extra shares. It was just if you owned 1 share of Apple by the deadline, they gave you 5 shares. What happened then is the price per share of their stock dropped about a 20%. It's going from about 500 to 100. And all of a sudden now it's more available for people. Now I know some of you out there are saying, oh, $100 is still too expensive for me. I can understand that. There are stocks cheaper than that. But when you look at the value, it's on sale. Let's say you want a pair of shoes that's normally $80, and all of a sudden now it's on clearance for $40. Well, hey, it's on sale. I wanted this. I can, let's save up my money for a few more days and go out and pay $40, $50 for this pair of shoes that's normally $80 to $100. Well, think of the stock the same way. If a company splits its stock, all of a sudden now it's on sale. And a lot of people use the term stock being on sale with the recent bear market that we just went through, where the stocks dropped into the 20% from their highs back in February, March. That big downturn we just had. People say, oh, it's on sale, let's buy it. That's on sale, but the value of the company, the value of the stock actually dropped. When a stock splits, it's on sale, but the value stays the same because the company hasn't lost money, and the stock price actually hasn't lost money, even though it looks like it has. Because you had 1 share for $500, and all of a sudden you have 5 for $100. So the value has remained the same. So you haven't lost money, the company hasn't lost money. They just made the stock more available for people to afford and be able to buy. And so is this an opportunity? Absolutely, absolutely it is. But don't just go out and jump into it. As I touched on previously, do your analysis of the company, get familiar with the company. And like we said, Apple is famous and people might be familiar with what Apple does and what they offer. But there's going to be times in the future where you're going to have a company that announces a split, and you might not be familiar with that company. Use this opportunity with current events of Apple and Tesla splitting to do research on what a split is, what a split offers, and the opportunities that are available with these stocks being on sale. And decide, is this right for me? I will never, what I tell people, I foot stomp, say, don't let anyone tell you, let people tell you, but don't ever let people bully you into buying a stock. Mm-hmm. Because all your friends are buying Apple or Tesla because it's on sale, and just because everybody else is saying, oh, you need to buy it, you need to buy it. Don't go out and buy it until you've sat down and you've had time to think, is this the right stock for me? Am I interested in this company? Will this company have a good future ahead of it? Is the company making money? Are the fundamentals good? Have I analyzed this company? And if you can sit down and say yes, then by all means, buy that company. And start off now with doing that with Apple, because that might be an easier pick, because there's going to be time in the future when someone tells you, oh, you should buy this company. And that's happened. There's been people that go out and they buy stock in a company without researching it, just because it was a hot commodity at the time. All their friends were doing it, so why not do it? And they just jump in without doing their proper research. And the next thing you know is that stock just starts going down and they've lost the value of their investments, which could have been prevented. Again, there's no such thing as safe. There are ways to mitigate your risk by doing proper research in the market.
Definitely got to do your due diligence. You can't just follow everyone else if they're all jumping on the bridge, And it goes down to you got to kind of take emotions out of the stock market, because if you see the stock's going down and you're constantly watching it, you're just setting yourself up for failure, because it could be going down one day and then jumping back up the next day.
It could be, yes.
Yeah, and like what you said earlier, that's more of a day trader's perspective on the stock market and not investing. That's almost like a full-time job, essentially, if you're a day trader. For myself,
and there's nothing wrong with day trading or swing trading. I swing trade myself most of the time. There are people that day trade and they're very profitable at it. They're very good at it. So it is, a lot of people are just anti-day trading. I don't think there's a reason to be anti-day trading, but day trading takes experience and it takes discipline and it takes knowledge and understanding of how the market works and the different patterns it follows. So if you are interested in day trading, by all means, do your homework and find a good day trading course that will teach you the proper analysis to do that. I say start with, before you jump into day trading, start with swing trading. And before you do swing trading, learn investing and build that foundation up so that you can have something to fall back on.
What is swing trading? I've heard of day trading, but what is swing trading?
So the difference between day trading and swing trading is just the period of time that you're holding on to a certain position, a certain stock. So the market is open from 9:30 a.m. to 4 p.m. So day trading is buying and selling within that 9:30 to 4 p.m. time period. Let's go back to our example of Apple. I'm going to buy a share of Apple at 10 a.m. The market's been open for half an hour. At 10 a.m., I'm going to buy it. And it goes up a few dollars, and then at 10:05, I sell it. And it goes back down a couple dollars, and at 10:15, I buy it again. And at 10:30, I sell it. And at 11 o'clock, I'll buy it again. And maybe at 1 o'clock, I sell it again. And that's day trading. So throughout the day, you're buying and you're selling. You're actively in and you're out in the same trading day. Swing trading is still the same thing. It's a short term, but it doesn't involve the same trading day. It might be you buy it Monday and you sell it Tuesday, or you buy it Monday and you hold on to it for a month and then sell it, or you hold on to it for a week or two and then you sell it. Whereas investing is more of the long-term game. You're looking at you're going to buy this thing for maybe 3 years, 5 years, 10 years, or longer down the road. And with that, that's where you really got to be emotionally unattached, because in that time period of 3 to 5 to 10 years, that stock is going to go up and down. And there are people that are so emotionally invested in their investments that that's when they start having the physical problems, the people that have the blood pressure and the ulcers and the heart attacks, because they're so fixated on their investments. And that goes back to having your financial foundation of have a budget. And yes, have money in investments in the stock market, but you also want to have money in savings accounts. And I know we discussed that a savings account is not the place to have your money to let it grow, but it's a perfect place to have your money protected. Because a savings account is not going to have the rapid volatility, the ups and downs of the stock market. Yeah, if you put $100 in the savings account a year from now, you're still probably going to have that $100 and maybe 4 cents in interest.
4 cents.
Whereas with the stock market, you put $100 in, you have the potential, the possibility of a year from now, it could be $200 to $300. At the same time, you have the possibility of it being only $10. And so that's when you balance your portfolio. You lay the foundation of, you're going to put maybe 10, 15, 20% of your take-home pay in the stock market. And the rest of it is going to be allocated in maybe a savings account or a mutual fund, a CD, things like that. Again, there's no such thing as safe, but I'm going to use the term safer investment. And by that, it just means they're less volatile. You're not as emotionally invested in those places where your money is as you are in the stock market. And so when you keep yourself balanced like that, that's how you prevent yourself from losing all of your money. You hear about people that lost their entire fortune. They lost all their money. Well, the best way to not lose all of your money is to not put all of your money in the stock market. I'm 100% for investing and learning how to invest and put money in investments in the stock market, but don't put all of your money in the stock market. Keep part of it in a savings and a checking account, because that's how you protect your money. That's how you keep it safe. You balance the risk with the reward, with the safety, with the volatility. And eventually they play together, they combine to give yourself a good portfolio and a good foundation.
I think what Gary Vee says that really resonates is cash is king. You know, you always got to have that emergency fund. You got to have savings.
Right. Yes.
Even though it doesn't have a high yield savings, it's cash, and it's, you know, you might need that down the road. So don't have all of your eggs in one basket. Now, going to a beginner, if they wanted to get into stocks today, how would you recommend them to choose a brokerage? How would you have them analyze what's the best brokerage to go to? And we're not trying to push anyone to one way or the other, like
right.
Charles Schwab. I personally use Charles Schwab. I've loved them. I think they're actually attached with USAA now, so it makes it very convenient. And for me, I love their platform because it's very simplified, and they even have educational tools on it that teaches you how to use the platform. So I use Charles Schwab personally, but you guys don't have to use it. But there are other brokerages out there that you can get into if you want to start investing in stocks. Now, Adam, how would you recommend a beginner to choose a brokerage that best suits them?
Well, you want to shop around. Just like anything, if you're going to buy a new car, you want to get the best deal. What does this car have to offer me? What options does it have? Does it just get you from point A to point B, or does it actually offer air conditioning and a stereo and everything else? The same thing applies when looking for a broker. You use Charles Schwab. I use TD Ameritrade for my investments. Other people use Robinhood. So it depends on what do you want out of the broker. What I tell people is you want to look for customer service. Do they have customer service? Do they have 24/7 customer service? Is their customer service available on the phone, on chat, on email, on Facebook? How do you want to get involved and interact with the customer service? If you have a question about your investments, how soon are you able to get in touch with someone in that broker company who can answer your questions? Some brokers offer 24/7, some brokers don't. And so there are some brokers that are easy. I'm not going to say they have poor quality customer service, but some have better quantity customer service. Other things to look for are what kind of investments do they offer? Not every broker is going to offer you stocks, mutual funds, ETFs, crypto if you're interested in that, foreign currencies, foreign exchange. There's different brokers offer different investments available to you. And so you want to look into what broker is able to give me the best options that I have to invest. The other thing is I encourage people to look for what's called a trailing stop loss. When you utilize a trailing stop loss, that's another way to mitigate your risk. And a trailing stop loss is if you buy a stock at $10 and you want to put a $1 trailing stop loss on it, that means it goes in at $9. Now, so you buy a stock at $10 and you have this trailing stop loss at $9. If that stock goes up to $11, the trailing stop will go up to 10. If the stock goes up to 12, the trailing stop will trail it. And again, that'll keep that $1 distance. You probably want more than $1. I'm just using that to keep simple basic math for the explanation. What that does is all of a sudden, if your investment goes from $12 and drops, it's going to hit that stop loss marker and sell, and you'll be out of your investments.
I see, okay.
Well, some people might say, well, I'm in it for the long term. I don't want to do that. Well, you don't have to. Don't set the $1, but maybe you want to set a 13 to 15% trailing stop loss.
Yeah, like a big drop.
Stop loss. You don't have to lose, right? You don't have to lose any more than what you're willing to lose in the stock market. There's ways to mitigate your risk in the stock market. Too many people will invest in the market and they'll just drop it and they'll watch it drop. And they're sitting there watching the news and say, oh, my investment's going down, my investment's going down. They'll look at their portfolio, the email they get saying, hey, your investment's dropping. Oh, I'm down 10%, I'm down 20%. What am I going to do? Well, you don't have to endure that if you don't want to. If you want to put a stop loss at 10, 15%, then at that 10 to 15, 16, 17%, you'll sell your investment automatically. That's a great way to input investment, set a trailing stop loss if your broker offers it. Not every broker does. And just because they do or don't doesn't make them a good or bad broker. Again, it's up to you to decide if you want this or not. But that's a way to mitigate your risk is buy your investment, set the trailing stop loss, and then put it to the side. We've said a couple times here of you want to trade without emotion. And that's just one more way to do it is if you buy it and set the automatic trailing stop, all of a sudden now you're no longer worried about should you buy or should you sell, because you've already determined you have a plan, an exit strategy saying if it drops this much, I want to get out of it because I don't want to lose more than X amount of percent. And so if you set that, it'll do it for you. You can be sleeping, and if the market goes down, if your investment drops to whatever percentage you set, it'll sell it for you. So look at, and the other thing is commissions. When you buy a stock, a lot of brokers these days are offering free commissions. Not everyone does. So you want to check and see how much will it cost you to buy that stock? Is it just the face value of the stock, or do you have to pay for the face value of the stock plus pay your broker to be the go-between? And what a broker is, I like to explain it. I know you used the example of a grocery store earlier. Let's switch analogies and just say the stock market is online shopping. Whether you're on Walmart's website or you're using Amazon, that's what the stock market is. The stock then is the products you want to buy. The broker is UPS or FedEx or the post office.
Okay.
That's the stock from the market to you. And so now all of a sudden you have a brokerage account, and these days people don't have certificates. They might be available if you want. But these days it's just more convenient for everything to be stored electronically in your online brokerage account. And they keep track of how many shares of stock you own. And so that's when you're going to look for is look at their customer service, look at their commissions and their fees, look and see if they offer trailing stop losses, see what platforms are available. These days, with modern technology, most brokers are going to have a mobile app. Just something to check. Do you want to have an app on your phone that you can check and see how your investment's doing. You want to be able to use their website. Do they have a tablet app available? Are you able to call in, and do they have a hotline available where you can, if you're old fashioned, you just want to use the phone to call and see how it's doing? Everything else that you can think of. You're giving somebody else your money. What kind of questions do you want to ask someone who's going to be holding on to your money? How easily are you able to transfer money between your bank account and your brokerage account and back and forth? What is the fee for transferring money? How easily accessible are the funds that you have in your brokerage account? All those questions and any more that you can think of yourself, or, hey, I'm giving my money to someone else. What assurances do you want that your money is safe with them?
I think those are all great pointers on how to choose your brokerage and shop around wisely. I think it really helped a lot, clarified a lot of things for beginners out there that are looking to get into a brokerage without just saying, oh, I got to go to Robinhood because everyone's on Robinhood right now. It's so easy.
Right.
And I think, yeah, thank you for sharing that with everyone. And to close things out with our last question or topic, the difference, what is the difference between having a Roth IRA and an individual account? Because when I started my portfolio, I ended up opening both. My mentor at the time, he told me, hey, make sure you open both. One has obviously a better tax advantage than the other, and it's better to have, both instead of just one. Now, could you break that down for beginner, why they need to have both a Roth IRA and an individual account, or why they don't need one?
Right. So an IRA is a retirement account. And so you have a traditional IRA, which is you pay the taxes, you're going to invest your money. And with a lot of times with retirement accounts, you got to be careful because you can't withdraw your money until the current age is around 60. I don't know, 59, 59 and a half, 60, 65, somewhere in that age range is where you are not able to withdraw that money without penalty. You can withdraw, but there'll be financial penalties for early withdrawal. So you put your money in this IRA, or perhaps it's the 401k or a TSP or 403b. Those are all types of retirement accounts. And most of the time they follow mutual funds. So if you're interested in seeing how your IRA is performing, you can actually do research on a mutual fund, which I touch on in the PowerPoint. If those of you who have access to it, they can contact you or contact myself if they would like that. But the difference between a traditional IRA and a Roth IRA is the traditional IRA is you're going to pay taxes on it once you start to withdraw. So let's say for 30, 40 years, you've been putting money into this account. You're 60 years old, it's time to retire, get your house in the countryside, travel the world. You're gonna take that nest egg, but now let's say you have to pay taxes on it. How much money do you think you're going to be having after 30, 40 years of investments? And what do you think the tax rate is going to be? A Roth IRA is you pay taxes now on it so that when you withdraw it at that retirement age, you don't pay taxes. The pros and cons of that is with the Roth IRA, you pay taxes now, but you can't invest as much because obviously you're paying taxes on it. With the traditional IRA, you might be able to have more of an investment now, but you have the potential for higher taxes later. So those are things you have to weigh and balance yourself. And that Roth is a distinction, whether it's a Roth IRA or the TSP now has a Roth option. There might be a Roth 401k option that those of you who, if you're not in the military or you have an alternate retirement plan with another employer that offers a 401k or 403b, if there's a Roth option, it's the same thing. Pay taxes now or pay taxes later. The difference between that and an individual account of just buying stocks is with stocks or a mutual fund, an individual brokerage account, is you can buy today and sell tomorrow. We discuss day trading, we discuss short-term swing trading, and though you might not want to do that without the proper training and education, it's still doable. An example of mine is I had a mutual fund. It was not an IRA. I had my IRA separate, and then I had a mutual fund. And a few years ago, I was rear-ended. I was at a red light, and the vehicle came up behind me and just plowed me through the intersection. Oh, wow. And I need to get a new vehicle. Yes, the insurance paid a couple $1,000s on it. I had my emergency fund, and together I combined those, and then I also sold my mutual fund. And so I sold my mutual fund. I took a loss on it because obviously I'd only had it in there for about a year, and I planned on having it in there for more years so it could grow. But I haven't actually dig into that mutual fund. I'm not saying do that. Again, get with your financial advisor, find out if that's what is right for you. For me at the time, it was right for me. I've since regained my investment. But I was able to liquidate my mutual fund with no financial penalty. because it was not an IRA. So that's the difference. Is you can have a regular mutual fund, a regular stock, and you can buy today and sell it tomorrow if you want. You can buy today and sell today if actually necessary. Or with an IRA, a 401k, a TSP, you don't have that option. You can do that, but you're going to face financial penalties for doing so.
Okay, so the individual, there's more flexibility if you want to take money out and invest it in versus a Roth. It's more so, hey, you got to leave it in there. And with the Roth, I think you can only invest up to $6,000 a year. Is that correct?
Mm-hmm. The current year, yes, that changes from year to year. In previous years, it was only $5,500. It was last year and this year, it's been raised to $6,000. And so that might fluctuate a little bit from year to year. But yes, with an IRA, there is a cap on it. And so let's say you maxed out, you put $6,000 in your IRA. Well, what do you do now? You have extra money that you are able to invest. Now you can look into another brokerage account and maybe invest in some other independent mutual funds aside from your IRA. Maybe you want to do some research on some stocks or ETFs that would interest you as well. That's another way of balancing your portfolio and having that allocation spread out so that you don't have, if the market takes a big hit, your investment in life savings aren't completely lost because you haven't spread out according to what your financial plan is.
And with your Roth, do you suggest like, hey, only invest with index funds, or do you recommend, hey, you can put individual stocks in that too, or just put all your individual stocks in your individual account? Like how would you sort that out?
I think that goes back to your experience, your understanding, and your knowledge of the stock market. If you're more experienced, then you have more flexibility with choosing what type of investment to make. I myself, I have my IRA in an index fund. And I recommend index funds. Again, they're for beginners, but they're also for veteran investors because they're easy to track. All you got to do is listen to what the news is saying, or read an article that says, hey, the S&P 500 went up or down today. My IRA follows a NASDAQ index fund. So all I need to know is, hey, the NASDAQ went up or down today. And I know that's what my mutual fund did. That's what my IRA did. I don't have to spend a lot of time researching it. I just know whatever the index is doing, that fund should be following. So if you have an S&P 500 index fund, if the S&P 500 goes up, guess what? Your index fund went up. If the S&P 500 goes down, your index fund went down. And so that's why I recommend those for those who are just getting their feet wet in investing, is choose an index fund because they're simple and easy to understand, and they're a lot easier to follow. And from there, take the time, educate yourself, and see if you want to get into individual stocks and other funds as well.
And it's definitely good to diversify your funds, like you mentioned before, instead of having all your eggs in one basket. Cool. Well, hey, Adam, thank you. I think we've reached our time today. I know you got other things you got to do today too, but thank you for sharing all the information with all of us. And for those of you who have been watching this video, make sure you hit the like button and make sure you comment down below what you found best helped you out throughout this video and what value you were able to get from this video. And if you feel like others can learn from this video, or that you have family members or friends that could benefit from it, I can't talk today, make sure you send this video to them and share it with them, so that way they can learn the same information that we're sharing with you. For those of you that are military members or are just veterans that are wanting to learn how to invest, be sure that you also join Adam's Facebook group. It's called Like-Minded Military Investments. And in this video, I'll also throw his PDF that he shares in that group that he shared with me too. And it really helped me understand stocks at a basic level to get a good amount of confidence and know what I'm doing. And I will throw that in this video for you in the description below, so y'all can download that for free too. And then make sure you go to his Facebook group and join our group as well. But hey, Adam, thank you again for taking time out of your day to share information with us, all of us. Definitely will do another video in the future. And for those of you all watching, I hope you guys got some massive value out of this, and make sure you hit the subscribe button and the notification bell so you don't miss out on any future videos that we create together. Thank you, Adam. Thank you, everyone.
Thank you. Have a great day.
Take care.